I am AI avatar of CA Ratan Mundra. Indian companies are increasingly exploring offshore borrowing routes such as external commercial borrowings, also known as ECBs, and gift city financing structures. At first glance, dollar borrowing appears highly attractive because the base interest rate is much lower than domestic borrowing rates in India. Many CFOs initially see the low dollar interest rate and believe offshore borrowing is automatically cheaper. However, the real challenge begins when currency hedging costs are added. Since companies earn revenue mostly in Indian rupees but repay loans in US dollars, they must protect themselves against currency fluctuations. This protection comes through hedging, which currently adds nearly 3.50% to the borrowing cost. As a result, the total effective borrowing cost rises to around 8.25%, making offshore borrowing more expensive than many domestic rupee loans. When an Indian company borrows in dollars, it takes on foreign currency risk. If the rupee weakens against the dollar, the company must pay more rupees to repay the same dollar loan. Even a small depreciation in the rupee can significantly increase repayment obligations, especially for large borrowings. That is why hedging is extremely important. Hedging acts like financial protection against exchange rate volatility. Without proper hedging, companies can face major financial stress if the currency market moves unfavorably. But the current problem is that hedging itself has become very expensive. This high hedging cost has reduced the commercial advantage of offshore borrowing and discouraged many corporates from raising funds internationally. According to recent reports, banks have approached the Reserve Bank of India with a proposal aimed at reducing hedging costs for corporate borrowers. The idea is to create a special framework where companies hedge their loans through banks, while banks receive access to a lower cost support mechanism from RBI. The objective is not to eliminate currency risk, but to make risk management more affordable. If this framework is implemented, the effective borrowing cost for companies may reduce substantially. This could encourage Indian corporates to once again consider offshore debt as a viable financing option, especially for long-term infrastructure and expansion projects. Today, many top-rated Indian corporates can borrow domestically at approximately 7.25%. On the other hand, offshore borrowing through gift city or ECB routes may initially look cheaper due to lower dollar interest rates. But once hedging costs are added, the total borrowing cost increases beyond domestic loan rates. This comparison has become a key decision-making factor for CFOs and treasury teams. Earlier, offshore borrowing was considered an efficient source of low-cost funding. But now, due to expensive hedging, many companies prefer domestic loans despite higher headline interest rates. The entire economics of borrowing changes when hedging cost becomes too high. Let us take a practical example to understand the financial impact. Assume an Indian infrastructure company borrows 100 million United States dollars for 5 years. The base dollar borrowing cost is around 4.75%. However, after adding a hedging cost of 3.50%, the total effective borrowing cost becomes 8.25%. Now compare this with a domestic rupee loan available at 7.25%. The offshore borrowing becomes nearly 1% more expensive annually. On a 100 million United States dollars loan, this additional cost translates into nearly 1 million United States dollars every year. This clearly explains why many companies hesitate to choose offshore borrowing despite lower dollar interest rates. Now imagine a situation where the RBI supported mechanism successfully reduces hedging cost from 3.50% to 2.00%. In that case, the total effective borrowing cost becomes only 6.75% instead of 8.25%. This changes the entire financial calculation. Offshore borrowing now becomes cheaper than domestic borrowing by approximately 0.50% annually. On a 100 million United States dollars loan, this could result in annual savings of nearly 5 lakh United States dollars. Such savings are highly significant for sectors like infrastructure, renewable energy, aviation leasing, and financial services, where funding requirements are extremely large. If hedging costs reduce meaningfully, Gift City and the IFSC ecosystem could witness substantial growth. More Indian companies may choose offshore financing structures through IFSC banking units, treasury centers, leasing platforms, and structured finance arrangements located in Gift City. This can increase demand for banking services, legal advisory, treasury management, compliance consulting, and international financial transactions within the IFSC ecosystem. Gift City has already positioned itself as India's global financial hub, and a lower hedge cost environment could further strengthen its role in international capital markets. Even if hedging becomes cheaper, companies cannot ignore financial risks. Borrowers must still comply with ECB regulations, FEMA provisions, RBI reporting requirements, and sector-specific borrowing rules. Companies must also ensure that their borrowing strategy aligns with their repayment capacity and business cash flows. In addition, treasury teams should maintain proper risk management policies covering hedge ratios, refinancing risk, maturity mismatches, and stress testing scenarios. Offshore borrowing can provide savings, but only when managed carefully with strong financial discipline and compliance controls. Reports suggest that offshore borrowing volumes have slowed significantly due to high hedging costs. If RBI introduces a lower cost hedging mechanism, ECB flows into India could rise sharply in the coming years. This may improve capital availability for infrastructure and corporate expansion projects. Increased offshore borrowing can also reduce pressure on domestic banking liquidity and diversify funding sources for Indian corporates. However, policymakers will need to maintain a balance between encouraging foreign capital inflows and ensuring that external debt levels remain sustainable and financially stable. To conclude, the major issue in offshore borrowing today is not the availability of global capital. The real issue is the high cost of hedging foreign currency risk. If the RBI introduces a structured mechanism to reduce hedging costs, offshore borrowing could once again become attractive for Indian companies. But companies should never focus only on the base dollar interest rate. Every borrowing decision must compare the fully hedged offshore borrowing cost against domestic borrowing alternatives. A lower hedge cost regime can create major opportunities for corporates, banks, and Gift City, but careful risk management and regulatory compliance will remain essential for long term financial stability. Moon Says and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within Gift City and India, delivering end-to-end IFSC setup, operational support, and handling compliances. Risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive. Support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.